Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss a bullish butterfly. Now, if you have not watched our videos on selling call spreads and buying call spreads, our vertical call spreads, I would recommend watching that before watching this video because it combines buying a call spread and selling a call spread. And we're going to be under the assumption that you're already familiar with those strategies. And once again, if you're not, we'd recommend pausing right here and going back and watching our call spread videos before watching this one. So a question comes up oftentimes, why would I want to buy a bullish butterfly? Well, let's take a look at this example on what the trade actually is first. You'll see XYZ stock is at $45 per share. The 50 call is trading at $3 per contract. The 55 calls are trading at $1.40, and the 60 call is trading at 50 cents. If you combine these three, meaning you're buying a 50, selling two, not one, but two 55 calls, and buying a 60 call, your net debit on this trade is 70 cents. So why would you consider this trade? Well, first off, let's say that you're bullish on XYZ stock, but with volatility high, you really don't want to shell out $3 on a 50 call. That's a lot of money to you. And I'm just speaking relatively, of course. Let's say that you want to take this to the next level and maybe buy a 50-55 call spread. And by doing that, your actual cost would be the $3 minus the $1.40. That's a little bit better, but still a little bit more than you wanted to spend on the trade. However, if you buy the call spread, the 50-55, and simultaneously sell a 55-60 call spread, a butterfly has been born. And the cost of having this bullish exposure is only 70 cents instead of $3 if you're just buying the 50 call, or $3 minus $1.40, which is $1.60, if you're just buying the 50-55 call spread. So the whole reason to actually buy a butterfly out of the money is cost. There's no other reason to do so. Now, there's advantages and disadvantages of butterflies, but the main reason, if you're bullish, is that it costs less than buying a single call or a call spread. Now, butterflies are a trade that you can make neutral, you can make them bullish, you can make them bearish. It just depends where the middle strike is on the butterfly. So let's take a look at the trade example. First off, this is actually an example based upon expiration day pricing. That never happens, folks. So just have an understanding that as you trade these, you'll likely want to get out earlier. My rule whenever I'm trading bullish butterflies is I try to, can't say I always do it, but I try to take profit when it doubles. So if I were making this trade and I paid 70 cents, I would likely get out when the butterfly is worth $1.40 overall, regardless of what strikes are trading at what levels. That's where I would likely get out of this trade for profit. And then to the downside, well, that's just based upon your own risk management rules. But once again, you'll notice the maximum profit on this trade is that you can go from 70 cents to $5. I've never had that happen, and I've been doing this for about 20 years now. But typically if I'm doing a butterfly, I'm looking to get a small doubling of the money. So with that being said, let's take a look at this. What is the most you can lose on this trade? Well, let's say that the stock is at 45 and you have all these out of the money calls. If you do absolutely nothing and the stock never goes higher or goes lower, the most you can lose is 70 cents on this, not including commissions, of course. From there, the question then becomes your break-even point. Your first break-even point, and once again, this is based upon expiration, would be $50.70. Why would that be? Well, all the 55 calls would expire worthless, and all of the 60 call, or all of the 60 call would also expire worthless. And with that being the case, that 50 call itself would be worth 70 cents if it was 70 cents in the money. So that's how that would work. Now, from there, it gets a little bit more complex. There's advantages and disadvantages to every trade. The main advantage to a butterfly is the fact that you're paying less money for it. The disadvantage of a butterfly is that you can be too right, so to speak. How does that work? Well, if you want this trade to be worth $5, it would have to expire right at 55. That would mean that the 55 calls would still expire worthless. The 60 call would also expire worthless, but that 50 call that you bought is now worth $5, let's say. And if that's the case, then you are at the best possible place with which you can be with this trade. Now, where it gets worse is as it goes higher. You're looking to peak out at $55 a share. You can see the stock prices at the bottom, or the theoretical stock prices at the bottom of this diagram, and you can see your max profit is at $55 per share. However, as you go further up, you'll notice that the profit loss starts to become lesser and lesser again. And so by doing that, as you're maxed out on your 50-55 call spread, as you go higher, you start losing on the 55-60 call spread because you sold it. And you'll see that the other break-even point is at $59.30. That's 70 cents below the $60 mark. And then anything $60 or higher, the trade is worth $0. So have an understanding on here that the most you can make is $5. It's not going to happen, or highly, highly, highly unlikely to ever happen. Typically, what I like to do on these, and this is just my personal methodology, I like getting out of these when the stock goes up a little bit and the value of the butterfly is something with which you can make a profit. If the stock goes down significantly, well, you could lose all 70 cents just like any trade, but losing 70 cents is better than losing $3. It's a trade-off. No matter what you do, you're going to have advantages and disadvantages in every trade. The advantage of a butterfly, if you're being bullish, is that it only costs, in this case, 70 cents. The disadvantage is that if it goes up too high, then you could end up losing on the trade if it goes beyond your target point. Now, once again, you can set these trades up to be both bearish and neutral, as well as bullish, like we demonstrated today. If you think the stock's not going to move at all, you could set this trade up to make 45 your midpoint of the butterfly, or I should say the body. If you believe the stock's going to go lower, you can do all of this with the same concept, only you make it a 35-40 butterfly with the other, a 30-35-40 butterfly, and you could go downward with it as well and have the same effect to the downside. If you enjoyed today's video, please subscribe. That's how we get our content out to more people. Also, please follow me on Twitter. I try to get a lot of content out, and that's another way with which I can do it. If you're looking for a financial advisor who actually uses butterflies, if it's appropriate for the client, of course, then feel free to look me up. Go to stcharleswealth.com. Thank you.